Nobody likes tax season, but for new retirees, it can come with a few unwelcome surprises. The rules have changed, the income sources have shifted, and strategies that made sense during your working years may no longer apply. So today we're going to look at some of the biggest tax mistake retirees make, as discussed in a recent Kiplinger article, and whether these match what we see in the real world. Stay tuned.
Welcome to the My Retirement Clarity Podcast, where our goal is simple: to help you close the gap between what you know and what you implement. The team at JL Perkins Wealth Management does this by helping good people make great decisions so they can enjoy an amazing retirement. And now, here's your host and financial advisor, Lee Perkins.
Thanks for joining us here on My Retirement Clarity. Ben George with Lee Perkins, owner and financial advisor at JL Perkins Wealth Management there in Macon, Georgia. And they talking tax mistakes. I know a lot of people are thinking about that right now as we get even closer and closer to the tax deadline. But hey, tax planning and tax conversations are always important.
They are, but you're right. This is the time of year where it seems to be at everybody's forefront because they're getting their tax documents together and they want to, make sure they make the deadline. And so a lot of good conversation that comes this year, every year tax time. I will tell you this, though, Ben, most of the time people are sort of misguided on taxes altogether because I think the government has done a great job of kind of not brainwashing us, but getting us to look at a different scorecard, which is either an overpayment or an underpayment. And unfortunately, most people don't look at the line that I think matters on your tax return, which is the total taxes that you pay. That's what people really need to know, and that's where they can basically look at that and know, hey, yeah, I got back a refund of $1,000 and that's great, but man, I paid $29,000 in taxes. And if people knew that number and knew that was a real scorecard, boy, there would not be people happy at tax time because they got back $1,000.
Yeah, and what we're going to do today is take this Kiplinger article that we found and talk about it a little bit. The headline of it is the 5 biggest tax mistakes new retirees make in the first 5 years. We'll drop it in the show notes, so if you want to check it out yourself, you can do that. But we pulled out a few of these we want to discuss specifically. And remember, if you have questions for Lee, we'd love to hear from you. The easiest way to get in touch is talkwithjlp.com. That'll give you the opportunity to schedule a meeting with Lee right now, talkwithjlp.com. All right, so let's start with this first one on the list, Lee, ignoring upcoming RMDs. Now, we all know they're coming. We know the ages now for them, which you can refresh them since that's changed a little bit. But why do people often kind of put this on the back burner?
I just think there's a lot of confusion amongst the everyday person that we see in our office. They're not 100% confident of when the date is for RMDs. And honestly, a lot of people don't really know what a required minimum distribution is to begin with. And sometimes, like we had a couple in here last week, and one person was like, yeah, that's when they force you to start taking money. And then he was like, nobody's going to make me take my money. And she was like, yes, they are. And so a little bit of back and forth argument ensued. And then I basically, after they were finished talking, kind of stopped and talked through why an RMD occurs. And really, we kind of go through the whole trivia of why do you think there is an RMD? And of course, we all know the answer to that. The government wants you to take a required minimum distribution for the sole purpose of them receiving their tax money. And that's it. So we get into the whole deal of what can you actually do with an RMD. So there's a lot of uncertainty about RMDs in general.
Yeah, there are, and you need to start planning for them, right? You want to have a strategy for RMDs like you do for everything else in retirement, but again, the earlier you start planning for those, the more options you're going to have. So again, put that on your list, but that is a tax mistake that new retirees will often make. Number 2 on our list, Roth conversions done wrong or just not done at all. Lee, we know Roth conversions are powerful, but they can also be a little easy to misuse as well, right?
Yeah, I think a lot of people get confused between Roth conversions and Roth contributions. And sometimes we'll meet with people that have recently retired and they're like, I can't do a Roth. And again, it's just a little bit of semantics, but the two words are completely different. I like for a Roth conversion to happen, really I like for a Roth conversion to happen at any time, but probably one of the most advantageous times for a Roth conversion to happen is right after somebody retires, kind of, maybe in that early 60s time frame, or kind of all throughout the 60s is a great time. Every once in a while, we'll get somebody that will tell me that they're too old for a Roth conversion. And when we dig in a little bit deeper, in my opinion, you can't be too old for a Roth conversion. Again, paying taxes today at a known rate versus an unknown rate in the future is one of the whole advantages of doing a Roth conversion. But every once in a while, I'll talk with a couple that is pretty adamant that, hey, I'm okay if I leave tax-deferred money, IRA money, qualified retirement money to my beneficiaries, and they can just pay the taxes. If that's the stance that you've taken, that's fine. But ultimately, I'm of the opinion that your beneficiaries should receive more of your money than the government. But sometimes if it's done wrong, if people don't consider a Roth conversion and just never do it, lots of times the government can be the biggest beneficiary of your money, and that's not a good thing.
No, it's not. So again, Roth conversions, you want to have a conversation about these. If it's something you're thinking about doing or want to do, you just make sure you have a plan in place and a strategy for that going forward. And again, that all can start by going to talkwithjlp.com. All right, we're talking through tax mistakes here that new retirees make. And number 3 on our list here from this Kiplinger article, getting blindsided by Social Security taxes. Lee, do a lot of people just assume that, hey, I'm not got to pay much on taxes on Social Security? Because look, we know we've already been taxed our whole life. Why would there be another tax? But that's a surprise oftentimes with that, right?
It still is, and I think there's even some more confusion based on what happened in our political landscape a year or so ago when both of the presidential candidates were running on no taxes on Social Security. And so there is some confusion on that. I think we're getting closer to that, but for the most part, everything that was in place before this past election is still in place. Social Security is still going to be taxable for a lot of people that we see. Again, your taxation of your Social Security depends on what your income is. And up to 85% of your Social Security can show up as income on your tax return. Therefore, it can be taxable. So 85% is not your tax rate. That's just the percentage of Social Security that can show up on your tax return. So if you grab your tax return and you're already in retirement and you're taking Social Security, you can look at line 6A, and that will show you your total amount, unless they've changed that line number for this 2026, the forms for 2025. I don't think they have. Mm-hmm. Line 6A is going to show you what your total Social Security amount is. Line 6B is going to show you how much is taxable. And the income threshold is pretty low. You don't have to make more than about $44,000, $45,000 as a married filing joint person for 85% of your Social Security to be taxable. So if Roth conversions can be done earlier, before you're eligible for Social Security, or before you choose to take Social Security, you can actually save on your Social Security taxes. But again, you have to kind of make sure that you do all these things in sequence. And I think that's one of the advantages of working with a financial advisor who takes all this stuff into consideration. There's more to be gained than just working with somebody who's simply managing assets. And we get clients every single month from advisory firms that are just paying somebody to, they're just paying that firm to manage their assets, but they're not handling Social Security planning or tax planning or Roth conversions, all those kind of things. That's why we get clients, a lot of them, every single month, because we do handle these things in our office on a weekly basis. Hey folks, Lee Perkins here. I wanted to tell you about our brand new book called Next Phase: How to Retire in a Year or Less Without Regrets. It's all about helping you prepare for the next phase of your life, whatever that looks like for you. So, if you're ready to make the most of your next phase, or if you're already retired and aren't sure you're doing all you can to get the most out of your retirement, then you'll want a copy of this book. All you have to do is text Next Phase to 478-475-2050, and we'll send you a copy right away. You can also access additional resources and register for one of our upcoming workshops at our website, www.myretirementclarity.com. Thanks for listening. Now back to the show.
Yeah, you don't want to be caught off guard by these tax mistakes that other retirees might get caught off guard, and that's why you want a comprehensive approach to your retirement. And that planning can start now by scheduling a meeting with Lee and the team at JL Perkins Wealth Management at talkwithjlp.com. All right, as we continue looking through this article, there's another one here I want to get your thoughts on, Lee, and that's forgetting to plan for a spouse or your heirs. So this is one maybe you won't necessarily feel the impact of, but your loved ones will. So what do we need to be thinking about when it comes to planning for this?
Man, there's a whole section of conversation that needs to happen when dealing with a married couple. And it's not a comfortable conversation to have because ultimately it is a conversation that addresses our mortality. I've mentioned on the show before that I've had a conversation with my parents years ago, and my mom had a very difficult time with it because we're talking about what happens financially if something happens to my dad. And ultimately we tabled that conversation. Now we've since readdressed it and we have a good idea now, but for most people, that is something that they don't really consider. So what we began using here in our office is a scorecard. It's our next phase scorecard where we're actually putting in front of people the scenario of what happens financially when one spouse passes away. So immediately the first thing that happens is that spouse is going to become a single filer, not in the same year, but eventually that person is going to become a single filer. And this is where we reference something called the widow's tax. Now there's not an official widow's tax, but just going from a married filer to a single filer is pretty much, that's what the widow's tax is. A married filing joint numbers, they're more favorable than a single filer number. And so I think knowing that ahead of time is very helpful. I mean, I think planning for the income change that happens when one spouse passes away is a big deal. Most people that we see, they're aware that they're going to lose one Social Security. Hopefully, they understand that they're going to lose the lower Social Security. They will still continue to receive the higher Social Security. So Social Security planning is big, but I would tell you probably 75% of the people that walk in our office and they tell us, hey, we have a pension. My husband's been getting the pension for 6 years. When I ask the question, did he choose a survivor benefit or not a survivor benefit? 75% of the time, they do not know beyond a shadow of a doubt. So that's obviously something that we need to plan for, and I need to make sure that both spouses are aware of what that survivor benefit looks like. And so it's a big conversation when you're talking about planning for your spouses. And I think you referenced heirs in your kind of reference to this question here. When we're thinking about this from an heir standpoint, if you are leaving behind qualified retirement money and it's going to ultimately show up on somebody's tax return, I think it's a good conversation to kind of have an idea of where your kids are or your other beneficiaries financially, because if you die and leave your son $1 million IRA and he's your only beneficiary, he's going to have to start taking some of that money every year. If he's a high income earner, that's going to be taxed at a higher rate. So he's going to pay more taxes, and then we get, go back to our tax conversation. Who do you want to be the biggest beneficiary? Plan accordingly, make sure your beneficiaries are the biggest beneficiary and not the IRS.
Yeah, it all goes back to planning, right? These tax mistakes in retirement are rarely about carelessness. They're usually about just not knowing what to do, right? And taxes are not a very simple thing to deal with, especially for people that don't do this every day. So the good news is most of these mistakes are avoidable with a little bit of planning and the right guidance at the right time. And that's exactly what JL Perkins Wealth Management can help you with. And you can get in touch right now by going to talkwithjlp.com to schedule a meeting, or just call the office directly at 478-254-3550. Lee, we'll close it out on that note, but I know this is an important topic, and I know one that you care a lot about and work with your clients on, so I'm glad we were able to touch on
it. Hey there, Lee Perkins here. If you're like a lot of folks, you've been listening to this podcast for a long time now, but I've got an important question for you. Have you implemented any of the ideas that we've discussed on the show? If you haven't, what are you waiting on? You know you're not getting any younger, so here's my challenge. Don't just consume the content. Our number one goal for this podcast is to help you close the gap between what you know and what you implement. So if you're ready to implement, Take that first step today and visit www.talkwithjlp.com and schedule a 15-minute phone call with one of our advisors, and we'll help you close the gap between what you know and what you implement so you can enjoy the next phase of your life. Now is your time. Don't procrastinate any longer.
Investment advisory services are offered by J.L. Perkins Wealth Management, a registered investment advisor and insurance agency. Information is for illustrative purposes only and does not constitute tax, legal, or investment advice. Always consult with a qualified tax, legal, or investment professional before taking any action.